Welcome to the daily update, where I'll go over the action in the market for Tuesday, August 6th. And then we'll see how things look for Wednesday, August 7th. Monday was such an emotionally charged day. My goodness, you had people that don't even know about the stock market suddenly commenting about it and talking about it, and it's in the headlines everywhere. Well, that's usually about the time when things end. Unfortunately, by the time most people that may be involved in the market get a chance to do something, they're pretty much too late. That's why I really put a heavy analysis in these daily videos, because we saw things starting to develop last week, and we were able to take advantage of that and close out some positions on Monday for some really nice profits. No new positions were assumed on Tuesday because that violated the criteria of the program, in that we only would look at more bearish positions if we're actually going down. And we saw an upward bounce over 1%. But not enough yet to turn things back positive yet. We're seeing some signs of hope, but we're still dealing in the short and intermediate term with a negative environment, but still quite oversold. The long term is still positive. So we just want to evaluate things and see, are we going to be able to bounce up more from here and turn back and look positive? Or is this just a little bit of a bounce before we get set to go down and possibly even test the 200-day moving averages? I do have a program where I allude to this a lot in the video. It's called the SPXInvesting Program. It's still free for right now. There are links below this video that take you to more information about the program, as well as to the website. And here's an email address if you see the need to contact me. Also, this video that you're watching right now is the real foundation of the analysis and commentary that I do. All of the other videos are pretty much on a weekly basis, and they're meant to tie into the daily video. The one on the top, these are supplemental videos that I just do on an as-needed basis. All right, let's go back and talk about what happened and then look at some charts. We did have a higher open, and prices were able to get above R1 at 52.52 before retracing back below R1. Then we did try to go up again, but we didn't get up to R2. We're now dealing with the 100-day moving average being overhead resistance. And that's pretty much where we topped out on Tuesday. We didn't get to R2 at 53.17, and then we declined and ended up closing below R1. But we were still up 1.04% on above average volume. We are negative in the short and intermediate term. We're positive in the long term. We're just waiting to see, are we going to be able to work off some of this oversold condition and then keep going down? Or are we going to be able to bounce up enough and turn the short and intermediate term picture back to looking more positive? And this whole shift that we've been seeing has to do with growth concerns in the economy. We're not really getting any heavy-duty economic reports this week that are going to help with that. So the market's kind of left to its own devices for the time being. And then the geopolitical things going on. We're wondering, is there going to be an escalation in the Middle East? We've got the French Olympics going on still. There's unrest in England. So there's a lot happening these days. All right, some comments. We did see a bounce after Monday's decline, and it appears to be more technical rather than fundamental, meaning that in Japan, there were some trades that folks had gotten used to doing, and all of a sudden that was in danger and they had to unwind those. And that was causing a lot of havoc that bled over into their stock market, which then spread across the entire globe. So we'll have to see. Is there still more to come? JP Morgan thinks that there still is. Other people that I've kind of looked at some of their notes, they think, no, it's pretty much finished now. All right. So Japan did rebound over 10%. So they declined on 12%, or down 12% on Monday. Got back up over 10% on Tuesday, and so far on Wednesday, the last time I looked, we were up 3%. So they have been able to more than recoup the losses that we're seeing. And now, is the 100-period moving averages, are they acting as resistance? And I refer to them in the plural because we look at both a simple and exponential moving average. San Francisco Fed President Daly came out, who is a voter, and said that policy adjustments will be necessary in the coming quarter. That is seen as a dovish comment that the market liked. We still have a pretty long list in the short term, with the ADX looking extreme with the red line above 40, the Stochc RSI, CCI 14 and 20, the stochastics, the rate of change going back 5 and 10 periods, the force index, the slope oscillator, and the boom indicator. We're still kind of far away from that 20-period moving average. In the intermediate term, still have a list, but it's shortened down a little bit here. Also, the ADX is looking extreme negative with the red line above 40. The rate of change going back 20 periods, the ease of movement, and the chicken money flow. But we're seeing some improvements in our smart money indicators that I'll go through. The Fed, of course, they've been leaving rates higher for longer right now, but there are these economic growth concerns that are now starting to come into the market where bad news is bad news. And are they going to be cutting rates for that reason instead of cutting rates just to stimulate the economy? The market is pretty much anticipating a 100% rate cut in September. We just don't know how much that's going to be or if that's even going to really happen. That's why I say probability. Okay, the dollar was up and interest rates were also up. We closed at 3.89% with a 10-year yield, where we had been at 3.74%. We're still inverted with the yield curves, and sentiment is extreme negative. Now, when we get down to these low readings under 25, this is when we start to entertain the idea of using it as a contrarian indicator. That's another reason why I didn't open any new bearish positions on Tuesday. Was in Monday's session, we were coming down to intraday support at S3. We were also dealing with the 200-day moving average, like in the FANG index. And you could tell that Monday's session was pretty much all emotional. And so sentiment also dropped. But what we're waiting to see is signs of confirmation that things are actually looking a little bit better. But we're still coming in at 21, extreme negative, where we had been at 19. We're negative with our trend. The ADX is going above the moving average, and we're in a negative trending environment. With the up day, the bias is positive, but I'm still keeping our momentum at negative for right now. We just had trade balance come in as the economic report, and not really that much of a market mover. Came in a little bit higher or lower, I guess you'd say, more than expected to the downside, but down from the previous reading. So no charts to show you there. Here we have the overbought, oversold composite. Way over on the right-hand side, we're coming in at 60.28. That means we're pretty much working off this extreme positive condition and going back down into looking more neutral. And then this is looking at the average. If there's all kinds of things on this chart, but look at the green line here. The average S&P 500 pullback is 14.2%. Okay, we got down just under 10% in Monday's session from the high that was set in mid-July. That's not strange. It's not strange to see those things happen and then maintain the longer-term positive trend and then be able to go up from there, even though the media and it's like the perma bear who dismissed the 200% advance that was seen in the S&P 500. But yet on Monday felt totally vindicated with the almost 10% decline. It's strange how that works. All right, then looking at the returns following 5% pullbacks, and that's kind of where we're at. We're between that 5, but underneath 10% from the all-time high. And things tend to do pretty good going forward after something like this happens. And looking at the earnings consensus from Yahoo, where they do say things positive, even though they have them dropping off in the third quarter, going up in the first quarter or the fourth quarter here, and then trailing off a little bit. But the takeaway from this, because these get adjusted all the time, is that they're still seeing things positive looking forward. And we look at the mega cap valuations where they were above 30 with the PE ratio. We use 10, 15, and 20 as the base static numbers. Well, especially things like the mega caps, they don't stick to that nice, neat little box. They're coming down as we've been seeing them under pressure, and they're actually getting into 27, which is still very high. It's well above that 20 level. And the S&P, which had been above 20, has also been coming down, and it's right around the 20 level. So even looking forward, the market is still considered to be expensive. Then looking at the probabilities here from Goldman Sachs, they're bumping up their probability that we might see a recession here. So I take that for what it's worth. And then this is a chart which tries to match the year-over-year earnings for the S&P. That's dark blue. The light blue is CPI year-over-year, and then PPI is the yellow year-over-year. where some are going up, some are going down. But the case they're trying to make with this chart is that the inflation is typically a lagging indicator. And I'm not sure the market really anticipates these things. So yeah, we might see a bit of a delay with the charts, but the market is always trying to stay right on top of this. And we're seeing a lot of money going into more high quality bonds or high grade bonds as folks have been getting out of the junk bonds. They were willing to assume that risk to get a higher yield. Well, we're seeing that start to shift as they're getting out of the junk bonds and getting into more conservative bonds because they feel maybe rates have topped out and will start to come down. And so we're seeing a lot of money going into these higher quality bonds currently. And copper, which is a barometer of the economy, when this is going up, that means it looks good economically going forward. When it's going down, that shows economic weakness. And this is what some folks are citing as, hey, maybe we're seeing some economic weakness right now in going forward. Look at what copper is doing these days. And then I don't have any charts from Yardeni, just a little bit of a statement here where the Bank of Japan's governor came out. I'm not going to try to say his name and said, well, we're not going to raise rates while the market's going crazy. Well, that's kind of showing some nice wisdom there. And then Edward Yardeni puts his comments down here. The global stock market panic calmed down today, meaning Tuesday, as the over leveraged trade seemed to be washed out. And that's what was happening is you had a complacency with this carry trade where they could get something at a lower interest rate that they were borrowing and then be able to get a higher interest rate in return. That started to unravel, and some folks were just assuming this was always going to happen because it had been happening for a long time. And so they over leveraged themselves. And so when things started to go against them, that meant those trades were falling apart. That spilled over into the Japanese market, which then spread across the globe. And so he says, we didn't view the extreme sell-off as being fundamentally driven. It was more technically driven. Folks had to do something, not because things are changing economically. They had to do it because things were changing technically with their charts. And then it says, and then this is what kind of got me is on Monday, I don't watch CNBC anymore. I used to watch it from morning till night, but it's just a waste of time, in my opinion. Or if anything, I might go live on Bloomberg for every once in a while when I'm waiting for like the employment numbers or CPI or something like that. There are these hard landers who are saying, you need a 0.5% cut right now, baby, and another one at the next meeting. Well, okay. You're always going to have folks, no matter how much respect we try to give them, they can still say things that aren't very wise. And then what they're following here is, and this is a chart that I'll show you, it's the spread between the US and Japanese 10-year bonds. It would have narrowed, but this would have put even more pressure on what was already happening. And this is what some of those folks were calling to have happen. And they're, as I said here, they're calling for an emergency rate cut, but all right, yeah, all right. It gets people tuning into the channel. And they do this not only with the financial media, but they do with the regular media too. They're not trying to appeal to your intellect or to your logic. They're trying to appeal to your emotions. All right. Then an interesting chart here. Now, from time to time, I mention why are small caps doing better when interest rates are going down. This kind of shows that where you look at the dark blue line, the small caps, they have a lot more borrowed money, a lot more debt on their books than the bigger companies in the S&P. So that just helps these companies if interest rates are actually going down. And I don't like these. It looks like someone took a paintbrush and just splattered it on the paper here. But really all this is saying is that there were 3.3 million put options traded on Monday, a new all-time record. Okay, that's why I really, really stress watching these daily videos. We were lining up for this late last week, and we were able to take advantage of it on Monday, already involved in some positions while other people are then reacting to what's going on. What are those put options doing now? We're able to stabilize a bit on Monday, and then we went up on Tuesday. People are reacting, thinking they're doing the right thing because they're doing it based on emotion. Well, that's not real good logic there. All right. And then after Monday, we saw the U.S. stress index just climb off the charts. Not surprising. That's why another reason I didn't get into any additional bearish positions, because it's just, you could just tell the way the VIX was acting, or the way the financial media was acting. You had people posting things and talking to each other that they don't even know what's going on in the markets. And that's when you can pretty much signal that this is about over, at least for right now. And then this is kind of interesting. Comparing 1900 to 2023, the UK in 1900 had the biggest stock market, where the US was 14.5% of the total market cap. Now, of course, things have really switched, and we have the US. And what's kind of interesting is China, even though they're picking up a lot in volume, we still don't really pay attention to all that much, but they're not a big player, at least as of yet. And then another thing is that you notice that there aren't Eastern European countries. Where do you see Russia? Where do you see Ukraine? I know Russia has a stock market. I don't know about Ukraine. It might have got blown up by now, but they're pretty much irrelevant when it comes to the stock market, but they're very relevant when it comes to geopolitical events. All right. And then if you've watched these videos for very long, I think Jim Cramer is a total clown. He should be only treated as entertainment. Nobody should ever take his advice. And this is a classic example of that. He sent out a tweet at 2:45 a.m. August 6th. That was Tuesday, saying, a lot of damage done by this sell-off. Can't expect a quick bounce back. Well, look what happened. Okay, yeah, we can expect a bounce back. What? I just don't understand this. All right. JP Morgan says that this unraveling that we were seeing, it's only half complete. We don't know that for sure. It could also be replaced by something else that we're keeping an eye on as well. All right, let's go back and look at the chart where we had a bit of a gap higher, not a real massive gap higher. It was actually rather orderly. This seemed to be just kind of a nice bounce, just to say, okay, things are a little bit more under control. We got above R1, and then we came down to this blue line here, which sometimes I use and sometimes I don't. This one actually acted as support on Tuesday. You'll also notice that these red and green bars, I don't use these because this measures volume at certain price levels, but it only measures the volume that's of the chart that you see. It doesn't go back historically. And so I think that this is not a proper representation. All right, and then we came up, we didn't quite get to R2. This was at about the 100 period moving average, which now could be acting as overhead resistance. And then we drifted down and closed a little bit below R1. And not really much of a change. We're up again a bit in the initial overnight session going into Wednesday, but we're still seeing red line above the blue line here, meaning growth is outperforming value, value is outperforming growth on an intraday basis. But we saw a bit of an improvement here when we look at S&P growth to value. End of day, they were both up. Growth was up more, and that helped the large caps, but it was up, but up a little bit, not quite a lot more here for the mid caps, and it was up, but up less for the small caps. So we are still, and I don't know, I'm changing around how I'm preparing things here, and this seems to have gotten a little mixed up, and I've already recorded this video for the 5th time, so I'm just going to pretend that those charts didn't show up again. We saw a little bit of a bounce here with small cap growth to value, actually a decline with mid cap growth to value, and a little bit of a bounce with S&P growth to value, but nothing really to suggest any strength is coming back in, at least yet. And we're also keeping an eye on this. We have dropped below this 250 period moving average here. We were kind of holding out hope that maybe like before in April, we came down to this level and bounced up off of that. Well, now we have to get back into the rainbow for things to look even a little bit more positive here. And discretionary to staples just not doing well. Large cap growth came almost down to the 200-day moving average, not able to get back above its 100-day moving average. And we saw a bit of a tick up here with the small cap to large cap ratio. Actually, I'm sorry, it declined just a little bit as the small caps were up just a little bit more on a ratio basis. But we're still negative here. We had the red line on top. It's coming down. It's still slightly above 40. We're above the moving average. So this is a strengthening trend that's negative. We're also seeing that same thing here with the short-term ADX chart. And we're still above average with volume, even though we should be below average, but that's just not how things are happening right now. Here is sentiment where we ticked down just a little bit with the Ulcer Index and the VIX, which shot to the moon on Monday. It's kind of coming back down a little bit more. Still very high, but well off of where it had been. And so we're still seeing a lot of fear in the market. And the VIX of the VIX also really shot up, but starting to come back down, but still giving us quite high readings. The momentum for the VIX continues to be up. And we look at the volatility of bonds versus stocks, and we're still seeing there's a really strong correlated relationship between them. And we look at another ratio between the volatility showing in the VIX and the volatility of bonds in the MOVE index coming down, but still giving us quite a high reading. And then this is another area that we want to keep an eye on. This is the spread between risky and not as risky bonds. We're starting to see this go up. Now, this next chart is an inverted version of what we just saw, where this is causing a little bit of concern. This is the spread. When this is going down, that means the risk is going up. And of course, the VIX has been all crazy over the last few sessions. All right. And then we went down with the 1-day chart for the equity put call ratio, but we're still going up with the 5-day and the 10-day. And that's seasonally what we typically see at these times. We went up with this fear gauge, and we're actually declining a little bit with this other fear gauge. And we're seeing a real drop off here as folks were freaking out. They're going to a more risk off type of stance. And that's what happens when we see this ratio going down. And the volatility risk premium. And this is why it's on Monday, you could have been out there selling puts and just making bank on this stuff, because the chart that we saw earlier and this chart here, that just means these put options are a lot more expensive. And I was pointing this out in some of the website videos that I do, is like, okay, we're looking at a lot higher prices right now for especially put options. This is like buying insurance when your house is already on fire, okay? And you want to be buyers of options when we get down where the volatility risk premium is low. And when this is really high, that's when you want to start selling options. Well, most investors tend to do just the opposite of that. They buy when they're expensive and sell when they're cheap. So, yeah. All right. So a little bit of a tick up here with price and volume with the advanced decline line. We're still seeing more of a negative divergence based on volume. Holding up okay here with the new highs, new lows. It's not really showing any strength, but it's not showing any weakness right now. The 5-day and the 10-day continue to go down. And we're showing a bit of an improvement here with the advanced decline ratio. We crossed back above 0 with both lines. Now this, it's a little bit misleading because down below is the boom indicator where we're getting a really extreme negative reading. We're negative here when we look at accumulation distribution, but we have been flattening out here, even though we're still below a declining moving average. This could be showing some signs of improvement. Now, we can't just look at this chart and come to that conclusion. We need the other smart money charts to kind of say, yeah, I see where things might be getting a little bit better without a lot of proof yet. This is one area, the Chaikin money flow, negative, but it has been going up over the last couple of sessions, but not enough to turn the moving average back up. Also, the Chaikin oscillator, it's been going up for the last number of days after getting extreme negative. So when we take these three together, we can see how the accumulation distribution might be at least stabilizing. We're seeing a bit of an improvement back here with the Chaikin money flow, not enough to turn it positive yet. And we're actually starting to go back up with the Chaikin oscillator. So this is another reason I didn't open any additional bearish positions in Tuesday's session. All right, then we look at the S&P cumulative advanced decline line based on price, where we ticked back up. We fell a lot more based on volume, but we did see a bit of a bounce, and that's what we're going to see across the board here. A little bit of a bounce here with the NYSE cumulative advanced decline line, and we're still holding up fairly well with the regular advanced decline line on this chart as well as this additional chart. When we look at the common stock on the NYSE based on price, we ticked up. We declined more based on volume, but we did also bounce. And when we compare the NYSE with the advanced decline line with the S&P, even though they're on different scales, typically when the red line is above the S&P itself, that means we're doing pretty good on an advanced decline line basis. This is still holding up fairly well for the time being. And we're showing some improvement here with our advanced decline lines. We turned back up with the common stock, S&P, came back just a little bit above the moving average with the mid caps and never quite came down, but turned up with the small caps. Here's our daily chart. Not an awful lot to show here. I just plot the 50 and 200-day moving averages. The takeaway at the bottom here is that we continue to be above average with volume. And we're coming up, but still extreme negative with the Stochh RSI. The Williams percent R is no longer on the list because we're no longer extreme negative, but we're still extreme negative with the CCI 14 as well as the CCI 20. We're no longer extreme in the short-term stochastics. We're still extreme in the intermediate short-term, and we're continuing to decline with the longer short-term stochastic. And after really getting down here to the lower Keltner band, we bounce back up with the force index. And after showing a rate of change, just screaming to the downside, we might have overdid it a little bit back to the upside. Now we could still go up more from here, and we might see things stabilize a little bit. But this is just showing when we see extreme readings, that just means there's an awful lot of volatility in the market. We're looking at the 5-day rate of change. We did bounce up, but we're still extreme negative. Also bouncing back up with the 10-day rate of change, but still extreme negative. The condition of our 20-period moving average is still not improving. We're going back up with the 20, 50, and 200 moving averages here, and we're coming up a little bit. We were in the -3 standard deviations channel. Now we're in the -2. The balance of power is ticking up. It's still negative. The 50-period moving average is still, as long as we stay below these lines, we're just going to show a continuation of deterioration. And the go-no-go is stay home right now. We're still dealing with the lowest low part of this chart here. That's also negative. Not really much new here with the anchored moving average. We're waiting to see if we see more weakness. Are we going to come down to some of these other anchored moving averages? And we're extreme negative with the TTM squeeze. Also, here's a longer term version of that same chart. And on a relative basis, we're looking rather extreme with the rate of change going back 20 periods. We never got down to this kind of pinky line here, but when you look over the last year, this is about the lowest reading that we've seen in a while. And standard deviation, which does not measure direction, it measures speed. As we've been gyrating all over, this is picking up. And we're also bouncing up, but still extreme with the ease of movement. The Arun is below 0. That is still negative. And after being extreme with the S&P McClellan oscillator, we did bounce up, but we're still below 0. That's negative. So we are declining based on price and volume. In the shorter term, we were seeing this negative divergence where price was still going up as volume was going down. Longer term, you can make a case here that we were going up with the S&P as this was showing a lower high here. That's a longer term negative divergence. We were also seeing that before, not to quite the extent here with volume, but still it wasn't confirming what the S&P was doing itself. We just want to make note of this for right now. And we did see an improvement, but we're still negative with the NYSE McClellan oscillator. So we're going down with the NYSE summation index based on price and volume. We are negative with the Swenlin trading oscillator, both based on price and volume. Momentum is negative. We're already going down based on volume. We've recently just dropped based on price, and we're also dropping below the midpoint with the PMO. We ticked up a little bit with the PMOs that are rising. We're still declining with the buy signals. We're still going down with the PMOs above 0. We're negative with the Elder's Impulse system. We're negative with the parabolic SAR. We're negative and possibly extreme negative with the slope oscillator. We're negative with the MACD. So all of our momentum oscillators, and you can make a case for a lower high here with the slope, but we're not necessarily seeing that confirmed by our other oscillators. And that's one reason why I plot so many of these. Because somebody could look at this, make decisions and go, look at this negative divergence. Well, you're not seeing it on these other ones. But when you look at the short-term momentum, we are negative across the board. And now we came back up to the 100-period moving average, but we were not able to clear that on Tuesday. Is this going to present an issue to the market? And here also showing the current plotted moving averages. We're still extreme when we measure the distance away from the 20 period. We're showing some improvement here, but not quite as extreme with the distance from the 50. We continue to decline with our distance away from the 200. We turn back up with the Sean trend meter, but we're more neutral now. And we're still negative here with the bullish percent index. We dropped below 50. This had been an area that was giving us more hope. Well, after Monday, that hope seems to be at least in question for the time being. We're also dropping below 50 here with the NYSE bullish percent index after it had given us a very, very strong reading last week. Ticking up, almost getting extreme negative with the NASDAQ 100 bullish percent index, but until we get back above 50, this is still negative. And turning up but negative with the money flow, actually declining with the ultimate oscillator, but still negative. The vortex is negative with the red line on top, even though it declined. We're still below the moving average with on-balance volume. Another momentum oscillator, the Copic curve, is still negative. And we showed a bit of a bounce, but we're still negative with those stocks in the S&P above their 20-period moving averages. A little bit of improvement, but still negative with those stocks above their 50-period moving average. Turning back a little more positive with the 100-period moving average, and ticking up and still remaining positive with those stocks above their 200-day moving average. Ticked back up with the RSI 14. We had gone extreme negative with the RSI 9. That's no longer extreme. We're waiting to see if the mass index is going to generate a signal. This is a 3-part signal series. 2 of those 3 have been triggered. We're waiting to see what happens when number 3 is triggered. And we're keeping an eye on these fib levels. We didn't get down to this level, at least yet, but we'll be watching these if we see more weakness. And we're coming down. We dropped below the R2 level. We're actually using this R1 level as potential support. So we're seeing support intraday with S3. We saw support with the FANG index that I'll show you here in a moment. And we're seeing longer term support here with this pivot level. Maybe that's going to be enough to give the market some support, but we don't have any confirmation yet that things are turning positive. All right. Then looking at our fib extensions where we dropped down below, we were actually able to close right about at this 23.6% extension. And we came back into the cloud a little bit here with our itchy and scratchy cloud. And then the red line is still above the blue line. That's more negative. The green line did tick up, so that's a little bit more positive. But we just barely got back into this cloud now here. We're still negative on a trend basis, though, with the Heiken Ashi going down. The Kegi is pointing up, but it's red. That's still negative. The Renko chart is still negative, and the 3-line break is negative. But we did see enough of a bounce here to have 3 new X's drawn in, where we were seeing a double break dance down, whatever that was called. That signal is now gone from up here, and with this bounce with the 3 X's that came in, this is actually not generating a signal, but showing some improvement. And then looking at our 150 and 200 period moving averages, bounced up just a little bit and not extreme currently. So we're negative still in the short term. With the NASDAQ 100, we're still negative in the intermediate term. And stocks are negative in the short term. We're negative across the board with commodities. We're negative in the short and intermediate term with the dollar. No changes here. Somebody is asleep at the keyboard here. All of the sectors ended up being positive. We saw a nice little bounce from real estate. Tech was up. Healthcare was also up. That's more of a defensive area, but everything got taken out and shot on Monday. So to see all of these sectors up on Tuesday is not really surprising. And we saw some nice Christmas look here with red, blue, red, green, whatever you want to call it along the way. But the NASDAQ really bouncing all around here. The S&P was able to get back above 5,300. And we're still hanging in there with the equal weight. It's above the S&P weighted index, at least for the time being, even though they're on different scales. And so we saw just a little bit of a tick up with our ratio between the two. Not much of a change there. We're turning a little negative here with our new highs minus the new lows. We dropped below 0 on the NYSE. And we're coming back up. We're trying to get to the 50-day moving average here with the Dow, but we closed well off of those highs. We're still negative with the Elder's Impulse system with the diamonds. And we opened below the 200-day moving average on Monday, but we're able to get above it. And this is showing some improvement here, but not turning positive yet. Also below the 200-day moving average with the NASDAQ 100, showing some improvement, but not positive yet. We're still negative here with the Qs looking at the Elder's Impulse system. The momentum for the NASDAQ 100 continues to just shoot down and possibly looking really extreme at this point. And we're still down below this full retracement here, even though we bounced back up with the Qs on Tuesday. We did open below the 200-day moving average, and we're able to get back above that. That is positive in and of itself, but turning this back positive is not happening. What we're starting to see is the 20-period moving average dropping below the 50-period moving average, and that's more negative. But this is what we saw back in April. Doesn't necessarily mean it's the end of the world. We don't know what's going to happen after this, but it did repair itself as we worked through April and into May earlier this year. The small caps, and this is what I asked yesterday. Are we really going to find support at the 200-day moving average for the small caps? Well, right now it looks that way. And they were up 1.25%, showing some improvement, getting back above this S1 pivot level. But they are still negative with the Elder's Impulse system. And also here, looking at the Russell 2000 small caps, turning up after almost getting extreme with the RSI, bouncing off the 200-day moving average, but the momentum is still negative. And the mid caps also were able to bounce up off their 200-day moving average, but they're still below their 50-period moving average and remain negative with the Elder's Impulse system. The Wilshire, which it's not really getting back to its 50-day moving average yet, but it's still above its 200-day moving average. And also the same thing here with the total US stock ETF below the 50, above the 200. And the staples to tech ratio continues to tick down just a little bit here, but it's really been breaking out lately, and that's more negative action. We want to see this going down to turn back more positive. The FANG index, is this the area that we're going to find support? We came right to the 200-day moving average and bounced up off of that. Not seeing any real strength, not turning positive yet, but so far showing some hope. The dollar is down, even though it's still in a daily uptrend. Apple was down 1% between the 50 and 200-day moving averages, and Amazon was able to get back a little more than 0.5%. Microsoft was up over 1%, but still below its 200-day moving average. Right in between the moving averages with Google. Meta was up 3.86%, starting to come back up to its 50-day moving average. NVIDIA was up 3.78% after really seeing a decline and being recommended by Kramer last week. So yeah, it had to go down. And then Tesla was up 0.88%, but still below its 200-day moving average after recently generating a golden cross. Netflix was up 1.84% in between its 50 and 200-day moving averages. Still hanging in there with our broad market measure, the 5-period moving average of the highs minus the lows. We're still above zero, but we are declining. And we're seeing a stronger correlated relationship in the short term and long term with stocks versus US, stocks outside of the US. We want to keep an eye on oil. It's not really doing all that much right now. If geopolitical things escalate, we might see oil really start to spike. And here's Japan. This is only after Monday's session where we did bounce back up over 10%. Then I checked before I started recording, we're up another 3%, which would mean we pretty much recouped what was lost on Monday. And here is the ratio between the small caps and the tech sector starting to come back down. When this is going up, that means small caps are outperforming. When this is going down, that means tech is outperforming. And we bounce back up with the 10-year yield. Another thing that I neglected to mention in yesterday's video is you notice how interest rates opened a lot lower and then closed much higher. And then we look at this based on price, where we opened much higher and closed much lower, even though we were up based on price in the day. That was a little bit of a concern that I neglected to mention, but we did decline a little bit here based on price on Tuesday. Our growth to value ratio is not really doing all that well. Negative across the board here. Also seeing a little bit of improvement with small caps, but with the mid caps and the large caps, we're not seeing any strength. The S&P to utilities ratio continues to decline overall, and we're just barely above zero with the advanced decline line based on price, but we're still looking negative based on volume. And we're still pretty much going up, even though we ticked down slightly with the staples to S&P ratio. We want to see this going down, and for the most part, it's been going up. So what's our outlook for Wednesday? We're negative, and right now we're bouncing back, but we're still dealing with an oversold condition. But we're also dealing with a negative environment. We're going to get the MBNA mortgage applications index and consumer credit. We want to keep an eye on all the different geopolitical things in case they have an impact on the market. We're going to get weekly jobless claims on Thursday, and there's no reports coming out on Friday. And this shows you what is coming out on Wednesday. Seasonally, we're neutral to positive with the Dow, but we're just flat out negative with the NASDAQ. And when we look at Wednesday, based on what happened in 2023, this tends to be the most negative day of the week. And then we're dealing with a year now where the incumbent president doesn't run for re-election. And I can still only think of 2 or 3 times. Johnson, was it Truman? There might be other ones, but there's not a lot of historical data to pull from here. And this is updated here. This is going from 1949 to 2023. This is put out by Stock Traders Almanac, where we were way up here the last time I was showing this chart. Are we reverting back to the mean now, getting more down to earth with things? These are all the election years where August tends to be fairly positive. Well, here it's a little bit at the end of September and October where they look negative. And then all the post-election years, okay, all post-election years, okay, is that the year after? I'm not quite sure. But this looks negative a little bit more going forward post-election, but we're pre-election. Okay, anyway, September ends up being pretty negative from 1929 to the present. Also here, wake me up when September ends, but during an election year, August tends to be when the market performs the best. So we're still watching those defensive areas, staples, utilities, healthcare, wondering if energy is going to be a cause of it geopolitically, wondering if that's really going to cause a problem here. We're not seeing really much improvement with growth to value or discretionary to staples. Our 5 and 10-day equity put call ratio charts are going up. And then we're seeing some potential improvement here with our smart money indicators. Accumulation distribution, flattening out on down days. Chaikin money flow, starting to turn up even though it's still negative. The Chaikin oscillator going up after being extreme negative. We don't want to front run this, but we want to just say, okay, we see some hope lingering out there. Now we need to see it followed through based on price. The S&P and NYSE McClellan oscillators and summation indexes are negative. They're all below 0 and going down. The Swenlin trading oscillator is negative. The bullish percent index for the S&P, the parabolic SAR, ease of movement, even though it bounced up, is still extreme. The money flow, the vortex, the oscillators, the ultimate oscillator, the Copic curve, and the bullish percent index for the NYSE. All of these are negative. And we're possibly still extreme negative with the momentum of the NASDAQ 100, and we're still negative with the bullish percent index for the NASDAQ 100. So our list is still pretty short on the positive side. The advanced decline lines are holding up. The financial sector, it's still just a little bit below its 50-day moving average, but it's still in a longer-term uptrend. Our conclusion, we're negative, but we are dealing with an oversold condition, and as of right now, we appear to be bouncing. Now we're going to see, can that bounce continue? Can that bounce get enough momentum to actually turn things back positive? In the short term, we're negative, but still dealing with an oversold condition as we are in the intermediate term, but we're still positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.